What is double entry accounting? Double entry accounting is a fundamental bookkeeping and accounting method that ensures every financial transaction affects at least two different accounts. This system provides a comprehensive view of a company's financial health by recording transactions in terms of debits and credits. Key components of double entry accounting: debits and credits. In double entry accounting, each transaction involves both a debit and a credit. A debit increases asset or expense accounts while decreasing liability or equity accounts. Conversely, a credit increases liability or equity accounts while decreasing asset or expense accounts. The principle behind this is that for every debit entry made, there must be an equal and opposite credit entry to maintain balance in the ledger. Accounts. There are 6 main types of accounts used in double entry bookkeeping. Assets. Resources owned by the business, for example, cash and inventory. Liabilities. Obligations or debts owed by the business, for example, loans. Equity. Owner's interest in the business after liabilities are deducted from assets. Income. Revenue generated from business operations, for example, sales. Expenses. Costs incurred in the process of earning income, for example, rent and utilities. Dividends. Draws. Payments to owners. The accounting equation. The foundation of double entry accounting is the accounting equation. Assets equals liabilities plus equity. This equation must always remain balanced, meaning that any increase in assets must be matched with an increase in liabilities or equity. Transaction recording. When a transaction occurs, it is recorded in at least 2 accounts. For example, if a bakery purchases equipment worth $10,000 on credit, it will record a $10,000 increase in its equipment account asset as a debit and a $10,000 increase in its accounts payable liability as a credit. This dual effect helps ensure accuracy and provides checks against errors or fraud. Benefits of double entry accounting. Improved accuracy. By requiring 2 entries for each transaction, it reduces errors and discrepancies. Enhanced financial reporting. It allows for the creation of detailed financial statements such as balance sheets and income statements. Better decision-making. Provides insights into financial performance which aids management decisions. Historical context. The double entry system was developed during the mercantile period in Europe to facilitate trade and commerce. It has been linked to the rise of capitalism as it provided merchants with better tools to manage their finances effectively. In summary, double entry accounting is essential for businesses as it offers an accurate representation of their financial position through systematic recording practices that adhere to established accounting principles.